Alert, global debt market crisis, silver price. Surges past $95. Stack while you can. That's not a suggestion. That's what banking insiders are doing right now, while publicly telling you it's just another commodities cycle. $95 per ounce. But here's what they're not broadcasting. Physical silver in certain markets is already trading at $127. Same metal, two completely different prices. One number for the public, another for those who know what's coming. The question isn't whether the debt markets are collapsing. The question is, how much time do you have left before the window closes completely? Welcome to Currency Archive. If you value straight talk about your financial future without the nonsense, hit that subscribe button below. And drop a comment telling us where you're watching from. Because what's happening in the silver markets right now doesn't respect borders. Tuesday, January 20th, will likely be remembered as the day the global debt system began showing cracks that could not be ignored. On this single day, the yield on Japan's 30-year Treasury bond surged by more than 8.61%. To most people, this number means nothing. To those who understand debt markets, this number means everything. When a developed economy's bond yield moves this violently in a single trading session, it signals something fundamental has broken. This is the kind of movement analysts expect to see in Zimbabwe or Venezuela, not in the world's third largest economy. Japan is not a struggling emerging market. It is a sophisticated, industrialized nation with advanced financial systems. When its debt markets move like a currency in collapse, the implications extend far beyond its borders. Silver understood this immediately. On the same day Japan's bond market convulsed, silver smashed through $95 per ounce, reaching as high as $95.86 before pulling back slightly. This was not coincidence. This was confirmation. Gold followed the same pattern, breaking above $27.40 and setting new all-time highs. The precious metals complex moved as one, platinum up 5%, palladium testing major resistance levels, mining stocks surging in confirmation. Markets were sending a clear message. Something in the global financial system was breaking. The question most investors failed to ask was simple. Why Japan? Why now? The answer reveals the true scale of what may be unfolding. Japan carries a debt-to-GDP ratio exceeding 200%. This makes it the most indebted developed economy in the world. For every dollar of economic output Japan produces, it owes more than $2 in debt. This alone would be concerning. But Japan's role in the global financial system makes this crisis exponentially more dangerous. Japan holds over $1.2 trillion in United States Treasury securities. This makes them the largest foreign holder of American debt. When Japan faces a debt crisis of its own, it has very few options available. Traditionally, when bond yields surge in a developed economy, the central bank steps in. They print currency, they buy bonds, they force yields back down through monetary expansion. Japan cannot do this. The Bank of Japan already tried this approach for decades. They printed yen aggressively. They held interest rates at zero and even negative levels for years. The result was not economic growth. It was inflation. That inflation is still present in their economy today. This means the Bank of Japan cannot simply print more yen to buy their own bonds and suppress yields. Doing so would accelerate the inflation they are already struggling to control. They are trapped. If they cannot print currency to buy their own bonds, what options remain? They could sell assets they hold in other countries. Specifically, they could sell their $1.2 trillion position in United States Treasuries. This is where the crisis becomes global. If Japan begins liquidating US Treasury holdings to defend their own bond market, they flood the American debt market with supply. More supply means bond prices fall. When bond prices fall, yields rise. Rising US Treasury yields create their own crisis. The United States carries over $36 trillion in total debt. The interest cost on this debt already exceeds $1 trillion annually. If yields rise significantly, this interest burden becomes unsustainable. The Federal Reserve would be forced to respond. They would need to print dollars to buy the Treasury bonds Japan is selling. This prevents yields from spiking, but it debases the dollar in the process. This is why silver moved to $95 on the same day Japan's bonds collapsed. Investors who understand currency debasement were positioning for what comes next. The scenario playing out is not theoretical. It is happening in real time. US Treasury yields gapped higher on January 20th. The 10-year yield rose over 1%. The 30-year yield jumped 1.24% at the open. These movements confirmed what the Japanese bond market was signaling. The interconnected nature of modern debt markets means no crisis remains isolated. When the largest foreign holder of US debt faces their own bond market crisis, the effects cascade across the entire system. European markets understood this as well. Major stock indices fell across the board. Investors rotated into hard assets. Precious metals surged while equities declined. The pattern was unmistakable. What makes this moment different from previous debt scares is the magnitude of the movement and the limited tools available for response. In 2008, central banks had room to cut rates and expand balance sheets. In 2020, they could print without immediate inflationary consequences because the economy was shut down. In 2025, those options no longer exist. Interest rates in major economies are already low by historical standards. Central bank balance sheets are already bloated from previous rounds of money printing. Inflation is already present in most developed economies. The traditional playbook cannot be run again without severe consequences. Japan's bond market sent this message on January 20th. Silver's move above $95 confirmed it. Gold's breakout to new all-time highs validated it. What most investors still fail to understand is that this is not a one-day event. This is the beginning of a structural crisis that has been building for 15 years. The global debt bubble is not popping overnight, but the air is starting to come out, and those who understand the signal are positioning accordingly. The Federal Reserve will never publicly admit what their balance sheet reveals. They built a system that cannot be unwound without collapse. This is not speculation. This is mathematical reality visible in their own published data. In 2008, when the global financial crisis struck, the Federal Reserve's balance sheet stood at approximately $900 billion. This represented decades of gradual, controlled monetary policy. Then everything changed. The Fed began purchasing assets at a scale never before attempted in American history. They called it quantitative easing. They said it was temporary. They said it would stimulate the economy and then be reversed once conditions normalized. 15 years later, the balance sheet sits at over $7 trillion. Normalization never happened. It cannot happen. Here's why. Between 2008 and 2014, the Fed expanded their balance sheet from under $1 trillion to over $4 trillion. They purchased government bonds and mortgage-backed securities. They created this currency from nothing, literally typing numbers into existence and using those numbers to buy real assets. The stated goal was to lower interest rates and encourage borrowing. Lower rates would stimulate economic activity. Businesses would invest, consumers would spend, the economy would recover. What actually happened was different. Asset prices inflated dramatically. Stock markets reached record highs. Real estate values surged. Wealth concentrated in the hands of those who owned assets. Those without assets found themselves priced out of markets entirely. This was not economic recovery. This was monetary inflation disguised as prosperity. By 2018, the Fed believed they could reverse course. They began selling assets from their balance sheet. This process is called quantitative tightening. The theory was simple. If expanding the balance sheet stimulates the economy, shrinking it should normalize conditions without causing harm. The theory failed immediately. In 2019, before the balance sheet had shrunk significantly, stress appeared in the overnight lending markets. Banks were suddenly unable to meet their short-term funding obligations. Borrowing costs in the Fed's repo facilities spiked to levels not seen since the 2008 crisis. The Fed was forced to reverse course. They began expanding the balance sheet again, not because of any external crisis, but because the financial system could no longer function without continuous monetary support. Then came 2020. The global health crisis provided the perfect justification for what the Fed needed to do anyway. They exploded the balance sheet from $4 trillion to nearly $9 trillion in less than 2 years. This was the largest monetary expansion in American history. All economic growth since 2008 has been an illusion. It was not based on productivity increases or technological innovation or improved efficiency. It was based on asset price inflation created by monetary expansion. When stock portfolios increase 200%, but productivity remains flat, that is not wealth creation, that is currency debasement. When real estate values double but wages stagnate, that is not a housing boom, that is inflation. The prosperity of the past 15 years exists only on paper. It disappears the moment the Fed stops printing. This is why they cannot normalize their balance sheet. This is why every attempt to reduce monetary support results in immediate crisis. The trap was set in 2008 when they chose inflation over deflation. Now they are locked in. The only path forward involves more printing, more debt, more debasement. And this is exactly why silver crossed $95 when Japan's bond market collapsed. Investors who understand this system know what comes next. $8 trillion sits in European bank vaults, pension funds, and central bank reserves. This is not abstract wealth. This is a specific, quantifiable position in American bonds and equities held by European countries. And it represents the largest economic weapon that will probably never be fired. Understanding why this weapon exists, why it cannot be used, and why it still matters anyway, reveals the true fragility of the current global financial system. George Saravelos is the head of foreign exchange research at Deutsche Bank. In January 2025, he published an analysis that most media outlets ignored. His conclusion was direct and unsettling. European countries own $8 trillion in U.S. bonds and equities. This is almost twice as much as the rest of the world combined. In an environment where the geopolitical stability of the Western alliance is being disrupted existentially, it is unclear why Europeans would continue playing this role. His statement was not a prediction. It was a question. Why would European nations continue financing American debt when political relations are deteriorating? The data supporting his analysis comes directly from the US Treasury. Their published records show foreign holdings of Treasury securities broken down by country. The numbers are striking. Japan holds the largest single position at $1.2 trillion. But when European holdings are combined, they dwarf Japan's position. The United Kingdom holds the second largest position after Japan. Belgium, Canada, Luxembourg, France, Ireland, Switzerland, Norway, and Germany all appear on the list of major holders. Together, these nations have financed American deficit spending for decades. They did this because the dollar served as the global reserve currency. They did this because the Western alliance was stable. They did this because it made economic sense. That calculation is now changing. In previous financial crises, coordination was automatic. And when markets collapsed in 2008, central banks worldwide established currency swap lines within days. When pandemic lockdowns threatened the economy in 2020, coordinated monetary expansion happened simultaneously across developed nations. This coordination worked because political relationships were functional. Leaders communicated. Alliances held. Economic self-interest aligned with geopolitical stability. That environment no longer exists. January 2025 saw the American president threaten tariffs against 7 European Union countries and the United Kingdom. The stated reason was their lack of support for American territorial ambitions regarding Greenland. Whether this represents serious policy or negotiating theater is irrelevant. What matters is the signal it sends about the reliability of traditional alliances. European finance ministers are now asking questions they did not ask in 2008 or 2020. If political relations are this unstable, why should we continue funding American debt? If tariffs can be threatened over territorial disputes, what prevents economic warfare from escalating? If the Western alliance is fracturing, why remain the largest creditor to a potentially hostile economic competitor? These are not hypothetical concerns among fringe politicians. These are active discussions happening in central banks and finance ministries across Europe. And here is where the situation becomes dangerous. European nations will not dump their $8 trillion position in American assets. Doing so would be financial suicide. It would crash the value of their own holdings. It would destabilize their own economies. It would be cutting off their nose to spite their face. But they do not need to sell. They simply need to stop buying. This distinction is critical. When the US Treasury issues new debt, someone must purchase it. If demand decreases even slightly, yields must rise to attract new buyers. This is basic market mechanics. If European central banks and financial institutions slow their purchases of US Treasuries by even 20%, the impact on yields would be significant. If they reduce purchases by 50%, the impact would be severe. And they would not be doing this as an attack. They would simply be reducing exposure to an increasingly unreliable debtor with deteriorating political relations. This is already happening in subtle ways. Treasury data shows that foreign holdings of U.S. debt have been relatively flat over the past 2 years, despite massive increases in total U.S. debt issuance. Someone is buying this debt, but it is increasingly the Federal Reserve itself. This is why the Fed resumed Treasury purchases in December. They are filling the gap left by decreasing foreign demand, but this creates its own problem. When the central bank buys government debt with printed currency, it debases that currency. This is simple monetary mathematics. The money supply increases, the value of each unit of currency decreases. In a coordinated global crisis response, this debasement is shared. All major central banks expand their balance sheet simultaneously. The dollar, euro, yen, and pound all weaken together. No single currency collapses because they all move in tandem. Without coordination, the burden falls entirely on the Federal Reserve. The dollar weakens alone. Inflation accelerates faster in America than in other economies. The reserve currency status comes under threat. This is the fracture that makes the current crisis different from previous ones. The political environment prevents coordinated response. European nations are questioning their role as America's primary creditors. Traditional alliances are under stress from tariff threats and territorial disputes. Meanwhile, global debt levels are at record highs. Total worldwide debt now exceeds $300 trillion. Every previous crisis occurred at lower absolute debt levels. This means each new crisis requires more monetary expansion to prevent collapse. More expansion means more currency debasement. More debasement means higher inflation. Higher inflation means more pressure on bond yields. Higher yields mean more expensive debt service. More expensive debt service requires more money printing. The cycle feeds itself, and it is happening at precisely the moment when international cooperation is breaking down. Japan cannot print its way out because inflation is already present. Europe is reducing exposure because political relations are deteriorating. The Federal Reserve is left holding the bag, forced to print dollars at an accelerating pace to prevent the entire system from collapsing. This is why precious metals are surging. Silver crossing $95 is not about industrial demand or mining supply. Gold reaching new all-time highs is not about jewelry consumption. These are monetary metals responding to monetary crisis. Investors are watching the fracture widen. They see the coordination breaking down. They understand what happens when the world's reserve currency issuer must finance its own debt in isolation. The outcome is currency debasement on a scale not seen since the 1970s. And unlike the 1970s, this crisis begins with debt levels 10 times higher and geopolitical fragmentation far more severe. Most investors made the same mistake on January 20th, and they saw silver hit $95 and thought they had missed the opportunity. They saw gold break to new all-time highs and assumed the entry point had passed. They looked at record prices and concluded they were too late. This is exactly backward. Record prices during the early stages of a structural crisis are not the end of the move. They are confirmation that the move is legitimate. Understanding the difference between price-driven speculation and crisis-driven revaluation separates those who preserve wealth from those who watch it evaporate. The technical signals appearing across precious metals markets in January 2025 were not suggesting caution. They were screaming confirmation. Silver's chart pattern told the story clearly. The metal had been forming what technical analysts call flagpole formations. These are sharp vertical moves upward, followed by tight consolidation periods. The consolidation forms the flag shape. The vertical move is the pole. This pattern repeats during strong trending markets. Silver formed a flagpole in late 2024. It consolidated. Then it formed another flagpole breaking through $95. The pattern was textbook. When markets move in flagpoles, they are not experiencing random volatility. They are experiencing systematic repricing driven by fundamental change. The consolidation periods between flagpoles serve a specific purpose. They allow the market to digest the rapid move. Weak hands sell to strong hands. Momentum chasers exit. Long-term holders accumulate. Then the next leg higher begins. Gold confirmed this pattern with its own technical breakout. For months, gold had been consolidating in a tight range. The pattern was visible on any daily chart. Higher lows, resistance near previous highs, volume declining, volatility compressing. This is how major breakouts develop. When gold finally broke above $2,940, it did so with a gap. The market opened higher than the previous day's high. This gap represented a shift in sentiment. Sellers disappeared. Buyers stepped in aggressively. Gaps during breakouts are significant. They show urgency. They show conviction. They show that market participants are willing to pay higher prices immediately rather than wait for pullbacks. But the most important confirmation came from an area most investors ignore, the mining sector. When precious metals rise on speculation or short-term fear, mining stocks often lag. Traders buy metal for quick gains. They ignore the companies that produce it. When precious metals rise on fundamental repricing, mining stocks lead. On January 20th, the GDX Senior Gold Miner ETF surged over 5%. This was not a lagging response. This was confirmation. Mining stocks are leveraged plays on metal prices. When gold rises 3%, miners should rise 6 to 9% if the move is legitimate. When they rise even more than expected, it signals institutional buying. Institutions do not chase momentum. They position for structural change. Their presence in mining stocks on the same day Japan's bond market collapsed was not coincidence. The broader precious metals complex added further confirmation. Platinum jumped 5% in a single session. This metal had been consolidating in a triangle pattern for months. The breakout suggested industrial and monetary demand were both accelerating. Palladium tested major resistance levels it had not challenged in over a year. Even the silver miners ETF, SEL, gapped up nearly 5% on heavy volume. Every segment of the precious metals market was moving in unison. This does not happen during false breakouts. This happens during paradigm shifts. Meanwhile, Bitcoin told a different story. The cryptocurrency that had been marketed as digital gold and a safe haven dropped below $90,000. While precious metals surged, Bitcoin declined. This was a critical divergence. If the move in precious metals was simply fear-driven speculation, Bitcoin should have participated. Fear drives all alternative assets higher when it is purely emotional. But this was not emotional fear. This was calculated repositioning. Investors were not fleeing to anything that seemed like safety. They were fleeing specifically to assets with no counterparty risk. Assets that had maintained value through every currency crisis in human history. Gold and silver are not someone else's liability. They are no one's debt. They exist independent of any government's solvency or any central bank's balance sheet. Bitcoin requires a functioning internet, electrical grid, and financial system to have any utility. When systemic risk appears, this distinction matters. The divergence between precious metals and cryptocurrency on January 20th revealed what type of crisis investors were preparing for. They were preparing for currency debasement, for debt default risk, for the possibility that counterparty chains could break. Understanding this context makes the strategic positioning decision clear. Governments facing debt crises have only two realistic options. They can default. This means refusing to pay creditors. It means economic catastrophe. It means loss of reserve currency status. It means the complete destruction of the existing financial system. Or they can print. Every government in history has chosen to print. They devalue their currency. They pay their debts in money that is worth less. Creditors receive payment but lose purchasing power. This is the path of least resistance. It is politically survivable. It maintains the appearance of solvency even while destroying wealth. And it is exactly what is about to happen on a global scale. Japan cannot raise rates without crushing their economy. They cannot print without accelerating inflation. So they will likely liquidate foreign assets, specifically US Treasuries. The Federal Reserve will print dollars to buy these treasuries to prevent US yields from spiking. European nations will reduce their purchases of US debt due to political tensions. The Fed will print more to cover this gap. The cycle accelerates. The money supply expands. The currency debases. This is not a prediction. This is the only mathematically possible outcome given the constraints all major economies face. And this is why silver at $95 is not expensive. Expensive relative to what? A currency that is about to be printed in unprecedented quantities? The correct question is not whether $95 silver is too high. The correct question is whether dollars will maintain their purchasing power. History provides the answer. Currencies always lose purchasing power during debt crises. Hard assets always preserve wealth during currency debasement. The Great Depression created more millionaires than any previous period in American history. Not because these individuals got lucky, because they positioned correctly before the crisis fully unfolded. They held assets that could not be printed, assets that maintained purchasing power while paper wealth evaporated. There will come a time to convert precious metals back into other assets. When real estate crashes, 60%. When stocks trade at single-digit price-to-earnings ratios. When productive assets become available at generational lows. That time is not now. Now is the time to hold assets that cannot be debased. Assets with no counterparty risk. Assets that have survived every monetary crisis in recorded history. The technical signals appearing across precious metals markets in January 2025 were not warning of danger. They were confirming opportunity. Silver's flagpole breakout, gold's gap higher, mining sector confirmation, platinum and palladium participation. These were not signs of a top. These were signs of a beginning, and those who understand the difference are positioning accordingly.